Time to talk about my favorite growth stock that I've probably covered here on the channel ever. This stock, as we go through these numbers and these financials, this is exactly what you're looking for when you're looking for an investment that's not out of the quote mainstream kind of mega cap tech. This company has profits, they have gross margins, they have growth rate. More importantly, they really control their cost, and this stock has really rewarded shareholders over the last year. This thing's up 53%. And so we got to talk about a couple of things. Look, are all the gains kind of priced into this stock? Can it continue this type of performance? We certainly will talk about that and more on today's show. What is going on, investors? Hopefully you guys are doing well out there. Time to talk about Enphase Energy, ticker symbol ENPH. Like I said, year to date, this stock is up 53% when the vast majority, I'm like, everything in my portfolio other than this has been going down. Now, there's a couple of reasons why. This stock checks literally every single box that you want from a stock. It has a massive revenue growth rate, including in the Q3 earnings, which were reported a little over a week ago. I think I was in Las Vegas. That's why we're just picking up this story now. But revenue came in at $634 million. That was 80% growth year over year. It beat expectations by over $18 million. They have positive earnings from a non-GAAP and a GAAP perspective. We'll come over here and we'll walk you through these so you understand that, look, okay, this is just one company. If you can apply what's going on with Enphase Energy at the other kind of growth stocks, under the radar stocks that you're looking at, well, it's a recipe for success. It doesn't matter what they do, whether they sell solar inverters or they sell, grass. If the financials look like this, and this is why we constantly go through these financials here on the channel, if they look like this, it doesn't matter what the company does, Wall Street's going to love it. Now, they also gave us Q4 outlook as well. Revenue expect between $680 up to $720 million. So quarter over quarter, we're going to go from about 634 up to at least 680, maybe as high as 720. What was Wall Street expecting? A number kind of right in that $700 million. In fact, the high-end estimate was for 718. So if Enphase is somehow able to come to that 720 number and maybe even a little higher than that, well, that will actually exceed analyst estimates, and the low end was at 665. The midpoint of that is about $700 million. That would be 70% growth year over year. Now, obviously, a company cannot sustain 70% growth rate forever, okay? And this company, as we look out into next year, is going to slow down to 52% growth in Q1 to about $673 million worth of revenue. And then you look out into the second half of next year, and you're going to go to like a kind of a 30% growth rate on this one. Then when we step forward into 2024, analysts, we only have one analyst covering this one, but we're going to go back to kind of a teens, maybe 20% growth rate, get to that billion-dollar run rate to where this is kind of like a $4 billion company on a yearly basis. So we have to look at this valuation, okay? $38 billion valuation. This is not cheap by any means. Certainly 53% ago, if you bought this on January 1st, yeah, that valuation absolutely lines up and makes sense. But even when I start to look forward at this point with Enphase, and you get to about a $4 billion company, again, $1 billion a quarter would turn you into about a $4 billion company. Well, yeah, you're still 10 times sales there, which is not wildly overvalued as long as they continue some kind of a reasonable growth rate and they continue to do it profitably, which this company looks like it's going to be able to achieve. And when you look at EPS estimates from Wall Street, they're just expected to continue to go up year after year, or in this case, quarter over quarter. Now, we've been on this one. We've done several videos on this one talking about the best growth stock to own. We did that 6 months ago. We did another video here 3 months ago saying this is one of the best stocks that I've seen. There was another video I did on this one about 8 months ago, reiterating the same type of thing. There's been other channels, though, here on YouTube that have called this one much earlier. I mean, this stock was like $40, $50, and clearly that investment has worked out beautifully. Now, from a very high level kind of view, here's what Wall Street really loves about companies. Okay, first of all, they love 80% growth rate. What they also love is the fact you've got big gross margins. Okay, they've got 42% gross margins in the most recent quarter. Those are up year over year. Okay, in this environment, we're seeing margins kind of compress at a lot of companies. This one's been able to expand them not only quarter over quarter, but year over year. They were right at about 40% a year ago, 41% a quarter ago. They continue to inch up. But what does Wall Street really love? Okay, they love that high growth rate on that top line. A lot of companies check that box. A lot of companies check the high gross margin box, but those stocks are down 60, 70, 80% this year. This company, what they've been able to do from an operating expense, so your cost side, has just been extraordinary. They've kept cost just at such a wonderful level that the profits are just raining down on this company. So here's your $634 million worth of revenue in the most recent quarter. Again, that was 80% higher than a year ago, which is here at $351 million. Your gross profit coming in at $267 million. That's considerably higher than a year ago when you're at just $140 million. But here's the most impressive thing about this company. You've bolted on just shy of about $300 million worth of revenue year over year, but look where your operating expenses went. You went from just $103 million in operating expenses last year up just $30 million to about $132 million worth of operating expenses. That is just beautiful. And then look what it did to your income from operations. A year ago, you made $37 million on $351 million worth of revenue. Fast forward a year and you're making now $100 million more on $634 million worth of revenue. This is what dreams are made of. And even quarter over quarter, it's impressive, okay? Quarter over quarter, you added over $100 million worth of revenue, and you added like literally just about $8 million in cost. This is just so well run. This company, the executives, whoever is in charge of this company is doing a wonderful job. And whatever they are being paid, it's probably not enough. And you know me, I don't ever say that. This is as good as it gets to have this type of revenue growth, but have this type of discipline on the cost side. Really, the only other company that comes to mind with high gross margins, high growth rate is actually Tesla. Tesla, as we know, very well-run company. The valuation, sure, is in the stratosphere on both Enphase and Tesla, but a lot of it is justified by the fact that they control costs so well, and a lot of that revenue growth flows all the way down into shareholders' pockets. You pull all the way down to net income, and it paints just a beautiful story. Last year, you printed 21 million or close to 22 million. This year, $114 million. Even last quarter was 77. So you went from 77 last quarter, 77 million in net income. I mean, we're talking about after everything is paid, and it's all the way up to $114 million. And again, okay, I understand on a 9-month basis, you printed $243 million. Those of you that really look at your price to sales and price to earnings ratio, you're looking at a $38 billion company. Okay, yeah, it's not cheap, but you do have to factor in you've got this mega growth rate, and there's certainly potential that these growth rates just continue to reaccelerate because there's not a lot of visibility from analysts as we get into 2024. And I was on this company's website. They have a lot of new products and they're constantly innovating, which is really surprising to me. The fact that their research and development over the last year, yes, it's gone up, but in relation to sales, it's really remarkable, quite frankly. Now, when you come over here and look at this from a balance sheet, that this is probably the reason why they're running this company so efficiently. Okay, they're not sitting on a mountain of cash like we see these stupid tech companies out here in California. So they can't be wild and just spending boatloads of money on R&D and sales and marketing and general administrative. They've done a really nice job. They have like $1.4 billion in cash. It's not a lot, honestly, on a $38 billion company. Inventory, it's up considerably. Okay, this is a kind of a beginning of the year view into basically 9 months later. Well, you went from 74 million and you kind of doubled your inventory. I don't really mind that when I'm looking at a Nike or an Amazon or some of these other companies where we're kind of concerned about the sales growth. I'm not worried about this company as they have such strong sales projections that, yeah, you've got to have the inventory there. And it appears that the fourth quarter the quarter that we're coming into is particularly strong with this type of company. As my guess is there's probably people that want to take like tax credits. I put my solar on towards the end of the year, basically planning for next year's taxes. If you tack on your solar kind of in November and December, well, you get to realize that there's huge tax incentives here in the United States and maybe other parts of the world. So you tack your solar on in November and December, and you get to realize that tax credit basically just a couple of months later. Roll through the asset side of the business, pretty asset light business, which is surprising to me. And then when you come over here, liabilities, there's basically nothing. They do have about $1.2 billion worth of debt. That's up fractionally from the beginning of the year, but nothing that I would be overly concerned about. I can imagine this company could borrow money if it needed to at pretty reasonable rates, considering the strong financials that the company projects here. Now, you come down to cash flows, and we pull down this $114 million worth of net income. Last year, you were sitting right at $22 million. So explosive growth on that net income, even quarter over quarter. Okay, you were at $77 million just last quarter, and you've accelerated that to 114. What's impressive about this company is the fact you pull down to the stock-based compensation line, and this is generous. Okay, this is generous stock-based compensation, but last year you were at $47 million. And despite the rapid improvement in this company from a cash flow, an earnings, a revenue perspective, it's only gone up to about $52 million. Now, there is some benefit in the fact that your stock is up 50%, and so you don't have to give as much away of it when it comes to that stock-based compensation. So they're benefited towards that. But we're seeing a lot of these companies out here in Silicon Valley and around the stock market where they're still just raining stock-based compensation, and they've had to do more and more of it as their stock pulls back. Basically the opposite. I mean, stock-based compensation has basically gone flat over this company over just not only quarter over quarter, but year over year as well. You come down here to net cash provided by the operating activities, and you're seeing improvement here from 113 last year all the way up to $188 million. And then when you stretch it out over here to the 9-month view, you went from 254 all the way up to $491 million. It's, it's what dreams are made of. I noticed that this company doesn't spend a ton on property, plant, and equipment, just $9 million in the most recent quarter. Look, when you have $188 million worth of positive cash flow and you only spend $9 million on property, plant, and equipment, very impressive. I'm watching like tech companies, which they don't even have like a product to sell, spend more than that in a quarter. They spent like $1 million on investing in a private company, and that's it. Like, it's just ridiculous. So this is an extraordinarily well-run company, and this is what Wall Street loves. Now, I want to show you something, okay? I'm going to slide this chart over. Well, what does this chart look like? Okay, you had this big run. You had basically sideways consolidation. You had a monster rally, and then basically a ski slope like give back, okay? Almost every stock that we're looking at, from Square to PayPal to, every single stock kind of looks like this, where they kind of chopped, had a big run, and then they basically gave it all the way back and came back to the bottom of sideways consolidation. So Enphase Energy actually gives you hope that when this trend reverses, well, if the company is well run and these things line up where you have high gross margins, high revenue growth, and then you couple that with controlling your operating expenses so you print net income and operating income, well, this is what can happen. Your stock can rally well north of 100%. This is like 200% from the bottoms, but year to date, you can rally 50% on this one. Now, are the good times over? Well, the stock's still in an uptrend, okay? I have these green channel lines, and they're probably not drawn in there perfectly, but it gives you a sense on, we're probably anticipating this one. It's right here at about 280. There is I divide these channels in half, because as you can see, the stock will hit resistance and sometimes support halfway into the channel. But if this one moves to the bottom of the channel, you should come south of about 270 on this one, and that can be your buying opportunity. If you buy it at 270, I would have a stop loss under the previous lows, which are here at about 240, 250. If you want to be a little more aggressive here, because this trend is going to break at some point and you're going to pull back. And if you pull back, there's just a lot of gaps and skips in this chart to where I could anticipate if you break this trend and you come south of 250, well, there's a high probability that you come all the way maybe back to the top of the support line, back at 200. Certainly from a valuation perspective, if we can shave 20, 30, 40% off of this valuation from a price to sales, price to earnings, price to cash flow would make a lot of sense. But right now, basically what you're hoping for is a lot of your other stocks that have done this kind of move turn it into this sometime over the next 18 to 24 months. This stock is certainly evidence of that. But what you're looking for when you're looking at kind of the quote speculative growth stocks is, yes, it checks the high margins. Yes, it checks revenue growth, but they've got to couple that with controlling operating expenses and printing operating income and net income. And Enphase Energy, out of every stock that I've looked at, does it about as well as I've ever seen. And that is why we've been singing this stock's praises. And that is why Wall Street continues to bid this stock up. As long as those things remain, and the biggest question mark is that growth rate into the back half of next year. Can we maintain 20% growth rate on this one? Because if we can't, that valuation at the current time definitely looks stretched. But if somehow this company can reaccelerate into the back half of next year, well, yes, it could easily and very comfortably grow into this whopping $40 billion valuation. Hopefully, you guys enjoyed today's video. I'll be back again soon with more. Good luck with your investments.